Okay, so let's expand, let's grow what we've been talking about looking at revenue expenditure. So we discussed this. If you look at the next video, we arrived at this idea of expenses plus assets. We arrived at this equation is equal to capital plus liabilities plus income. And when we're looking at profit, we are comparing income and expenses. Now, we spoke about this as though we were paying for the goods straight away. So we said, let's start the business. 10 plus 50 is equal to 60. And then we said you took all of that 60 and bought some expenses. And then you sold all of that 60 for 70. And that's what we said earlier on. And this is all money in the bank. Money going in the bank, money leaving the bank, money going back into the bank. And we defined profit as the relationship between all our expenses and all our income. By the way, I just keep mentioning that just to highlight this. If you notice, I've said that we sold all the expenses and I compared all the expenses with all the income. We'll come to discuss later what happens when we don't actually sell everything we've bought. We have some stuff left. What profit really is then. But this doesn't happen all the time. So let me get rid of all of this. Oops. Let's look at this differently. Let's look at a scenario where you don't actually pay for the good, but you acquire the goods. I mean, this happens regularly. We buy goods on credit. So imagine you buy £60,000 worth of goods on credit. So no money has left the bank. We don't have that scenario. But if you bought goods on credit, you received the goods, but it also means you now owe someone or some sort of company. And when you buy goods on credit that you tend to resell, the people you owe on credit are known as trade payables. Yeah, trade payables. So that's the equation still balanced. Now, it's very possible for you to sell goods on credit, which is why we recognize the fact that you have sold the goods, but you don't actually get any money. You get a piece of paper, like if you like the invoice, saying that you are owed 70,000, and that's referred to as a trade receivable. So you can see here that the money in the bank is still 60,000. I mean, ultimately, you would hope. I'm just going to do a pretend. I'm going to rub this out in a second. You would hope, right, that you will receive your 70,000 later on in the week. And when you do, this piece of paper, if you like, gets destroyed. So when you do get your money, you get 70,000 in the bank, and this piece of paper goes, if you like. 70,000. So this 70,000 disappears and the 70,000 goes in the bank. So both transactions, we always recognize two transactions for every single event. The destruction of this paper and the receipt of the money in the bank. But, I mean, we just have to wait until you actually receive the money. And when you pay the people you owe, eventually that 60,000 will go and you'll have 60,000 coming out of the bank to pay those people. So that's the transaction when you eventually pay them. But you see, you receiving the money and you paying the money has nothing to do with profit. I'll say that again. You receiving the money from the people you've sold to and you paying the money has nothing to do with profit. So let's just get rid of you receiving the money for now or you paying the money. Let's just go back to this idea. So you bought the goods on credit, 60,000, 60,000. You sold the goods, 70,000, and you have a piece of paper saying you are owed. Profit is still the record of the difference between income and expenditure, which is still 10,000. So our equation now looks like this: 60,000 plus we have 60,000 in the bank, and we have this 70,000 piece of paper, which is equal to 10,000 plus 50,000 that we owe to a bank, 60,000 that we owe to some sort of supplier, someone we put goods from on credit, and 70,000 income showing that we have sold goods. And again, the same idea with in terms of profit, we can move the XE over there, and so if you like, assets become equal to capital plus liabilities plus income minus expenses. And what we have here with our assets are the money in the bank and the piece of paper. I call this piece of paper an asset because if you remember in the previous module, we can sell that invoice. You probably won't get the same amount, but the point is that it's an asset. It belongs to you. You have the right to a receipt, a certain amount of money. 10,000, and we have liabilities at 50, at 60, income 70, and your expenditure is 60. And of course, again, your profit is 10, which we add back to profit. And that's really the secondary part. So what we're saying is, I mean, in terms of whether we've discussed revenue income and revenue expenditure, we're still saying the same thing. This is revenue income, this is revenue expenditure, but all I've done is to introduce a credit element to what we're doing, where we buy goods on credit and we sell goods on credit, and we can still determine what profit is, even though we haven't received any money in the bank. Okay, great stuff. I'll see you in the next video.